Hello, everyone. Happy Friday. Welcome to the final bar. Today, we'll talk about this raging bull market, a 1 week bull market at the very least. We'll talk about this nice rally into the weekend here at the S&P up over 3%, the Nasdaq as well. Materials at the top of the list, followed by some of the FAANG sectors like communication services and consumer discretionary. What does that mean with so much short-term strength leading into the end of the quarter? Ladies and gentlemen, this is the final bar. Hey, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the action in the markets using the toolkit of the technical analyst, using measures of price, breadth, sentiment, trend, momentum to quantify investor behavior, try to make sense of these markets in very uncertain times. A lot of strength through the course of this week. Some of my conversations this week have been sort of that balance, that delicate dance between recognizing and acknowledging short-term strength. And again, Friday's rally into the close certainly showing a sort of renewed push to the upside with the first 30 minutes, the last 30 minutes, sort of the key pivotal moments of the day, both showing a lot of strength. That's a pretty good dose of optimism leading into the weekend. However, what does that mean relative to the longer term trends? We need to talk about the different timeframes at work here. Bear market rallies, arguably what I would label this current move with a long-term weakness and short-term strength can be super seductive, super sudden, super severe, super tempting. We also combine that with the fact that we're at quarter end. Quarter end is sort of a meaningful time. We get to the market recap. I'll tell you a little bit about what that means and why it tends to be pretty strong for risk assets. Let's talk about the schedule coming up next week. So Monday and Tuesday, we actually don't have a live show. We have some really cool programming lined up for you. On Monday, we're going to dig a little bit into technical indicators. I'll share with you some best practices that I found are helpful when you're using those as an input into your process. On Tuesday, the 28th, we'll talk about how to identify stocks with strong signals. And there are a number of ways we can try to identify strength in any market environment. On Wednesday, the 29th, Samantha Leduc from Leduc Trading. She's a macro strategist, usually does bring some great long-term charts along with her. That's on Wednesday. On Thursday, the 30th, Sean McLaughlin from All Star Charts. He's their option strategist. So hopefully we'll get an option idea or two with some sense of how to play this sort of market with a lot of uncertainty. Let's continue on today's show with our Wrap the Week segment. On Friday, what we like to do is actually wrap the trading week, which what I mean by that is basically looking from last Friday to this Friday and seeing how things have evolved. Before we get there, though, I did want to share with you a poll we have. We always have a poll running on our Stock Charts live stream page at StockCharts.com, also on our social media accounts. So make sure you follow us on Twitter at FinalBarSCTV and Stock Charts TV's account as well. We asked you recently, know your technical indicators. Which of these is not based on volume? And we gave you 4 choices. On balance, volume. Probably a fair guess that that's not the one, although I did get a couple of you to bite on that one. The relative strength index, accumulation distribution, chicken money flow. So what you have to remember, and 88% of you absolutely right with relative strength index. The RSI has no volume component. It is purely based on price, and it's actually just based on closing prices. Now, it smooths that out using exponential averages and a couple different techniques to try to quantify momentum, but it's basically, when it comes down to it, the only inputs are closing prices, every day's closing price, and then a bunch of math to sort of turn it into an oscillator. The other 3 indicators are all volume-based. So on balance, volume, accumulation, distribution, Chaikin money flow are all attempts to look at a daily volume reading, but string those together over time and look at trends in volume. And any one of them, I think, can add a little bit more than just looking at a daily volume reading. Mark Chaikin, when I've talked with him, he's thought a lot about just volume as inputs. He designed both of those last 2 indicators, accumulation, distribution, and the Chaikin money flow. All of those indicators, by the way, are featured on our Stock Charts platform. I'd encourage you to check them out and see if they can add some value to your perspective. Let's continue on wrapping the week here. I'm going to shorten my chart to 4 days because we have the Monday trading holiday for Juneteenth. So we go back to June 17th, which was last Friday. We're looking at 4 trading days from last Friday to today. Let's see what actually happened with the markets here. So the S&P 500's in black. It finished the last 4 trading days up 6.6% from last Friday. Only one of the ETFs in our group here outperformed the S&P, and that was the NASDAQ 100 up 7.5%. This reminds me of my conversation earlier this week. I think it was Bill Baruch, I think on Wednesday's show, we were talking about, he shared the ratio of the Qs versus the Staples ETF. So QQQ versus XLP, which is a really interesting ratio to think about. It led me to post a video on my YouTube channel just yesterday talking about the XLK versus the XLU, sort of an adaptation of my conversation with Bill. Go to my YouTube channel called Market Misbehavior if you want to check that out, by the way. And it talks about the strength in technology, how important that is for a market bottom. We've certainly seen strength this week. Now, the question is that a sustained rally, right? Is that sustained strength for multiple weeks, which would be more of a meaningful appreciation in prices for now, at the very least? Really impressive bounce off of the lows. 7.5% in a week is not too bad. Now, everything else on our asset allocation list actually underperformed the S&P. And from the top, we have in purple, the Russell 2000 ETF, which was up 6%. In blue, Bitcoin up 4.2%. In orange, this is emerging markets up 2.5%. Just above the zero line in red, we have bond prices that's using the TLT, which is a treasury bond ETF, up 0.4%. Everything else was down on the week. The US dollar and gold both down about 0.6 to 0.7%. It's using the UUP and the GLD ETFs. And then in brown at the worst performers, the USO, the crude oil ETF, down 2.5%. Big themes this week: strength and growth, weakness in energy, right? And so sort of a reversal, sort of a reversion to the mean after the incredible run in energy. All of those names, like we've talked about, DVN, FAANG, COP, and others down pretty significantly over the course of this week, while some of the more growth-oriented stuff bouncing nicely. And that's with rates coming off a bit, quite a bit this week, and that's certainly helping things as well. Rising rate environments tend to be pretty tough for growth stocks. When interest rates can take a bit of a breather, it tends to be pretty helpful for growth stocks. Just to real quickly check in on what happened today and how this week actually played out. We talk about the strength of these asset classes over time. I did want to mention cryptocurrencies stabilizing a little bit here on Friday, and that's showing some strength. Now, we use Bitcoin as our one cryptocurrency on our asset allocation chart that we just reviewed. It's worth noting that was actually one of the worst performers of our 10 most liquid coins today. Ether actually up almost just over 8%, XRP up 9%. So these are some of the leading coins out of the top 10 that we track. So overall, cryptocurrencies finishing the trading week in a pretty healthy way. Now, those obviously trade 24 hours. They trade over the weekend. So if you are looking to scratch your trading itch, well, I would encourage you to be patient and relax. Interesting, at the very least, to watch sort of that trend over the weekend, because it certainly is a good, interesting gauge of speculative pressures. On a sector basis, as I mentioned in the introduction, some of the leading sectors: materials, communication services, consumer discretionary, all up over 3.8% just today. That's to finish the week in a pretty strong performance run. On the downside, energy, the worst performer, still up over 1%, followed by healthcare, utilities, consumer staples. So some of the defensive stuff that had been leading through most of this week, actually down at the bottom of the list today, still having a pretty decent return through the course of this week, but underperforming today. When you look at what individual stocks were on the move today, it's a travel and tourism trade at the top. So most of the top 10 lists, starting with the cruise lines, Royal Caribbean, Norwegian, both up over 15%, followed by some of the gambling stocks, Penn and Caesars up over 12.5% or so, and MGM, CCL, Wynn are all in the top 10, all up double digits today. So what's going on there? Again, to limit our discussion to the charts and what we're seeing here, nice bounce on some of these names. And this is the challenge with investing in equities at any point. If you're a longer term investor and your goal is to sort of track the trends, what you have to accept is the fact that there will be counter trend moves that are severe, right? And so if you gauge your performance, if your report card is one day, you're going to have a lot of, strings of really happy days and really frustrating days. It is really important to keep focused on the long-term trend. And that's what I would encourage you to think about with any of these charts. I like the contrarian bounce here, and I like the move off of the oversold levels. RCL with a nice move higher. And again, most of the cruise lines up pretty big today. RCL was the top performer in the S&P 500 here as I was checking just before the show started. But remember, this is coming off a very beaten down level. So while this is a quick move to the upside, while that's super exciting if you bought yesterday, and congratulations if you did, I wouldn't feel super comfortable holding this kind of thing overnight, only because this is a quick move and it really matches the rally that you saw in late May. That was another counter trend move. You went from around 48 up to around 58 in just about a week, and from there started the next leg lower. The key with this sort of with these sort of charts, as we've been talking about for many times on the show, is to think about these different time frames. Short term, nice rally, super impressive, absolutely right. But the question is, we're still, how far are we down year to date? And the answer is still a ton, right? Still coming off of, I don't even know, right? Coming from 80, 85 down to 35. We're already down about 60%. So, a jump of 15% is great, but you're still down a pretty significant amount. So it's worth thinking about the tactical time frame versus the long term. What would cause this to be more of a meaningful reversal? Number one, I would say a higher low, right? An indication that buyers are not just coming in on one day, but starting to accumulate. Royal Caribbean, if you look at the earnings this week, CCL reported before the open. I want to say, I don't have the list in front of me. I'm pretty sure that's when they reported today or yesterday after the close. I forget which one, but not great numbers. I mean, it was sort of like things are going to get better, but we're still taking a huge hit in 2022. That's not the type of news that I would expect the stock to rally significantly on, but there might be something deeper in here. I didn't look too much into the stories before the show. From a technical perspective, higher low would be encouraging. The 50-day moving average, unfortunately, is still 20 points away from where we're at. So that's not really it's not really super helpful. The question is all about the stability. Can we find that stability on this chart? Just to finish off our weekly wrap, I want to just hit the Mindful Investor live chart list. I didn't have a chance to update this yet for today's close, but my short-term market trend model will in fact turn positive with today's rally. It was negative as of Thursday's close, but the nice move higher today puts it back into the bullish column. So it remains long-term bearish, medium-term bearish, short-term bullish. That's about what things feel like after this week. Let's look at the moving average conditions. So as of a week ago, as we're doing the show, we're down to single digits of the S&P members above their 50-day moving average, up to 22%. So about 20% of the S&P in the last week have gone from below their 50-day to above their 50-day. That's a pretty meaningful number, actually. That's a nice bounce higher. Now, granted, we're still below 30% for both of these. It still tells you that most stocks are very much in a downtrend, very much below their 50-day moving average, just like the S&P 500. But conditions are starting to improve a little bit. The question going into next week, going into the quarter end, is whether we get a sustained move. And just to finish off here very briefly, quarter end is an important one for institutional investors. It's all about how your portfolio looks at the end of the quarter, end of March, end of June, end of September, end of December. And that's a year-end one, obviously, as well. There's a whole thing about window dressing, about making your portfolio look a certain way to demonstrate your strength as a stock picker at the end of that quarter. And then really aggressive bets, sort of your true intentions most likely are reinitiated after the end of the quarter, which means next week, I would guess most likely you'll see things start to be flat to up probably. And then the challenge is going to be after the 4th of July holiday. Then you're past the second quarter into the third quarter. You got a lot of time to figure things out before the end of September, which most likely could mean if there is going to be a renewed downtrend, that's probably when I would expect it to potentially reinitiate. Let's take a quick commercial break. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks for joining me every weekday after the close as we break down the activity in the financial markets. We have so much great stuff coming for you on StockCharts TV. Our StockCharts TV studio is under construction, under development right now. We'll hopefully this fall start initiating some really pretty programming for you on StockCharts TV. So a lot of good stuff to come. But let's talk about what's going on now. First off, we're going to do a mailbag segment a little later in today's show. We love to feature one of your questions in our next mailbag segment coming up next week. You can get your questions to us one of three ways: via email, thefinalbar@stockcharts.com, via Twitter @finalbarsctv, via YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air next week in our mailbag segments. Also, go to StockChartsTV.com. That is our on-demand platform. We are also on all of the major mobile platforms: Apple, tvOS, macOS, all those different things. We are there. Go to StockChartsTV.com to access all of our free, fantastic programming, or on your mobile device, just search for StockCharts TV on demand. Let's continue on this show with our next segment, Power Up. What we like to do with some regularity is talk about the tools within the StockCharts platform. I like to highlight some of the ways that you can upgrade your use of StockCharts to make sense of things. Now, in this sort of environment, I would argue it's all about recognizing which names are working. I'm reminded of my conversation yesterday with Mary Ellen McGonigal talking about healthcare names. And she always does such a great job of scanning for ideas, looking for strengths and weaknesses. I was exchanging emails with Larry Tentarelli from Blue Chip Daily. Same. He does a great job of sort of identifying names on the move. So how can you actually use the StockCharts platform to create your own list of names that you should be worried about or concerned about or looking at? I'd like to highlight our Scheduled Scans feature. If you go to Charts and Tools at the top of our website and go to Scheduled Scans, you'll notice, depending on what membership you have, you need to be a member of StockCharts to be able to use this functionality. You can actually automate different scans. So we have a whole set of predefined scans. So if you're struggling with where to start, that's a really good place to go. We have a bunch of our contributors which have written articles and chart school articles telling you and sharing different scans that can be helpful. So use the magnifying glass if you're searching for ideas that way. But if I look to the scan workbench, which is one of my, I like to hit this particular scan. This is stocks making new 52-week highs. And I like to scan for, there's different things you can do. I like to look for stocks making new 52-week highs. I like to incorporate a volume component, for example. As you could say, today's volume is X% above the average volume. Whatever you'd want to do, you can create that scan. And then when you go to scheduled scans, you can actually automate it. So if I say here, this is a scan for new 52-week highs on extra special volume. I want to run this every day at the US market close. And I want to merge it into an existing chart list, which would basically say, here's a list. I'm always going to have it populating with the stocks making the new highs on heavier volume. I can save my scan. Then basically you will have a chart list, which every day at the close will re-update with the newest members. You can see down at the bottom, I already have these things running for stocks making new 3-month highs and 3-month lows. That's where I get a lot of the ideas that I share with my market misbehavior premium members. By the way, if I run the scan of stocks making new 52-week highs on the S&P, and we do this, you'll see some interesting names that I wanted to just hit very, very briefly. Let's see, new list here. It's things like Brown-Forman, things like, let's see, which is making a new swing high. Bristol-Myers making a new high, which reminds me of my conversation yesterday. FedEx, which we talked about, can it get above 240? I actually did it today. So having these scans that are actually running behind the scenes every day at the end of the trading day, I get an email to my email account. I can go right in, click through and look at the individual charts. It is hard to not be up to date with what's happening in the markets if you use the scheduled scans effectively. Let's continue on today's show with our Final Bar mailbag. As a reminder, keep your questions coming. We're an email away, thefinalbar@stockcharts.com. And here's question number 1. With the limited number of inverse funds and the huge abundance of shorting opportunities in the market these days, I'm wondering why your investment approach is not to actually go short. Perhaps it's the unlimited investment risk that makes you prefer only long positions. Now, you also mentioned and it was a much larger question. I boiled down to that a little bit. You mentioned this classic short opportunity of where something breaks down below support, retests the support from below, and then rotates to the downside. And you're absolutely right. I've mentioned in videos before and on the show, I don't short stocks. Now, why do I actually do that? I will tell you, number one, right, making a decision of whether to go short, whether to use inverse funds, all of that, that is really an individual question on how you're trying to manage your portfolio. And I'd encourage you to talk to a financial professional if you're not comfortable with making some of those decisions and get some help on how to navigate those kind of things effectively. For me, to be honest with you, it comes from my time as an institutional investor. And when you are at a larger money management firm, you are incredibly limited on what you can do with your own personal money for a good reason, right? Part of the ethical standards that I subscribe to, being a CMT charter holder, is that I agree to take action for clients and others before my own personal accounts. So I'm not allowed to front run accounts or anything like that, or act on information first and then share it with people that could act on it as well. There's a whole bunch of ethical standards that kind of make sense and are common sense for a financial professional, but we have all sort of agreed as a community to abide by those things. As a result, I've never really been able to short stocks or use leverage in a way that's super practical for my own investment purposes. So for my own portfolio, I do very little. My time at Fidelity, we were mostly plain vanilla, long only equity investors. That's the majority of my background and my career, and that's where I'm most comfortable. That's where I feel like I have an edge over others potentially, and so that's where I tend to do it. Having said that, as I probably have mentioned in different shows, I do use inverse ETFs tactically. I'll use them in the short term if I feel like there's an opportunity, there's a clear move for the market lower. And during 2022, at times I've initiated some short-term inverse ETF positions to bet on the short side of things, and overall have done pretty well. The challenge with shorting stocks in general is exactly what you alluded to in the question. You have unlimited risk because the price can go up for a long time. Now, the problem with that is if you own something that is inversely related to the market, if you're short and the stock goes higher, you have an unlimited loss. Now, you're limited to your, potentially your exposure and margin calls and all those sorts of structural things. But, when you buy a stock and it's a long position, you have unlimited upside and limited downside. When you flip that over and when you're shorting stocks, you have limited upside because you're limited to the stock going to zero, but you have unlimited downside theoretically. And so, when you're shorting stocks, you are betting against the broader history of equities. And that's why that's my short version, or maybe somewhat long version of why I don't go short with any consistency. I have put a video on my YouTube channel, a couple of those, by the way, talking about inverse ETFs and some of the challenges with those and what to be aware of. So make sure you check those out if you've not seen those yet. Next question. It's generally considered foolish to sell out, hoping to buy back at lower prices when your high conviction holdings crash. What makes sense to do instead of selling? That is a really thoughtful question. And what happens if you owned a Microsoft, which I have up on my screen? You've owned it for this whole time going into year end. You're feeling pretty good because it's chopped around a little bit, but still hasn't really broken down. And then all of a sudden things start to break down. And what if you're still holding something and you're sitting on now something where your paper profits had been much higher and now you've given some of those up? So first off, I would say is I don't know if I would 100% agree with the phrasing of your question. You said it's considered foolish to sell out, hoping to buy back at lower prices. I think that depends on your time frame. What I always tell people is if they're owning Microsoft at this point, is what sort of loss are you comfortable with, right? Certain methodologies like William O'Neill's methodology has like an 8%, 7 or 8% loss, right? If you have a position, you're down 8% from your entry point or from a recent high, then you should exit the position no matter what, no matter how tied you are to that position, because it tells you it's just not working right now. And you want to reevaluate it and find a better time to get in on it. And that's meant to limit climactic loss, right? Limit you holding something as it's really struggling. I would also say there's a great benefit to stop losses, right? So even just looking at Microsoft and tracking as it's trading relative to its 50-day moving average or its 10-week moving averages. A lot of methodologies would include that, or something more sophisticated like average true range, the chandelier exit system, parabolic studies, which Wells Wilder designed a number of years ago. These are all trailing stop techniques to help you lock in profits on the way up and minimize losses on the way back down. I don't think that's doing it wrong. I think that's foolish to be acting on that. But what I think your question is what do you do instead of just selling everything? I think that's what I would encourage you to think about. Simplistically, we often think about, do I own it or not? Am I 100% long or 100% out, right? 100% in cash. Remember that there's a lot more nuance that you can do. You can accumulate positions over time. When there's an initial breakout, you could take a quarter size position and then add another 0.25% or a 25% when it reaches another threshold, and then put in the final 50% when it does something else. When it hits your initial stop loss, you could take half of the position off the table and leave the other half there. And so remember that, by adjusting your exposure, not just saying I'm all in or I'm out, but thinking of it as more of a series of steps that you can take, a lot of times will allow you to take some of the initial profits out, make sure you lock in some of those gains, but leave some of it to work in case the stop was premature. So that's what I would encourage you to do. Number one, use some more sophisticated ways to as trailing stops, but also focus on the opportunity to have different levers, not just all in and all out. Final question, most likely here. I have read many technicians use the VIX level of 24 to gauge market sentiment. I heard this particular level mostly at StockCharts. What is the importance of this particular level? Yeah, really good question. When I talk about the VIX, you'll remember, and on yesterday's show, if you missed it, we had a whole series on sentiment indicators. Spend a little bit of time on the VIX. I think absolute levels like that are a little oversimplifying, and I've heard the same thing, and I know many think about the VIX at 20, the VIX at 24, 25. And I get it, because if you look at the deep history of the VIX, that's about right. And that's where those numbers come from, right? A level of 24 makes sense if you look at the long-term history. When the VIX is below 24, we've usually been in a fairly sustained bull market phase, like you see in the middle of 2021. When we're at VIX above 24, that usually means that stocks are struggling, stocks are choppy, the volatility is increasing. 2020 completely ruined that whole idea of the VIX of 20 or 24 as having any sort of meaning at all, because it was an incredibly volatile environment, but netted out to a pretty decent uptrend overall when all was said and done in December of 2020. So I tend to think of things a little more dynamically, and I tend to think of things in volatility regimes. I found the VIX to settle into certain ranges for about a 6 to 12 month phase. I think in 2020, it was an elevated VIX between 20 and 40 for most of the year. In 2021, we settled into lower volatility between 15 and 25. Now we're in a new volatility regime with 20 on the lower end, 30 to 35 on the upper end. We are coming out of that upper end elevated VIX, by the way, and trading back below 30, which is why I think this is a decent size bounce we're going to see this week, potentially going into next week as well. Great questions, all of you, and thank you so much for sending them. Keep them coming. We'll get to more of them next week if we can. We need to wrap the show. Go to the 3 and 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. And here is chart number 1. Let's talk about 1-year returns. I spent a lot of time thinking about year-to-date returns, week-to-date returns, which is what we shared earlier in our Wrap the Week segment. But this chart is just looking at the last 1 year. Now, the end of June of 2021, I don't know if that's a particularly special moment during the uptrend that we saw last year, but it's just a time in the middle of the bull market phase. And by looking at 1 year ago to where we're at now, we see the S&P is down about 7%, which isn't bad, right? For a 1-year return. It's not great. Don't get me wrong. Much higher would be better, but it's not horrible. If you look at a 1-year return, I mean, it could be much worse. All the other ETFs that I'm showing here, which are all sector ETFs, have outperformed the S&P over the last 1 year. Here's materials down 5%. In green, we have healthcare up 4.8%. In red, 12% higher for utilities, 36% higher for energy. And that's coming off of almost double those percent returns a couple of weeks ago. So energy has certainly taken it on the chin in the last week. You can see these others are bouncing higher. But my point is, any one of these one sector ETFs would have given you, in some cases, dramatically better performance than the S&P itself. It's a great reminder that there's alpha to be had. There's opportunity to be had rotating on sectors. Here's the other side of that coin, unfortunately, is the sectors that have been underperforming. Here's the S&P again, down about 7.5%. Technology about the same, the S&P down 7%. Technology down about 7.5%. So we can see that those two are pretty much in line over the last 1 year. Technology and the markets have been kind of in alignment. It's been about the same. That shows you the weight of those names like Microsoft and Apple and others. Now, these other two are why the FAANG stocks have been struggling and why there's been so much weakness. In red, consumer discretionary down 16%, 29% lower for communication services. So it pays to be in the stronger sectors. Finally, I'm impressed by the bounce in cruise lines, the travel stocks going into the weekend here. They're coming out of an oversold condition, which is certainly encouraging for the short term. The question is, though, how does that map to long-term reversals? I would argue a chart like RCL has a lot to prove before it would get more bullish. For me, what's the base case? Get back above 50. That was the support from May. We broke down through that level in early June. We're now rallying a bit. Can we get above there? Can we get back to 50 and not just stop, but continue higher? That's another 8 or 9 points from where we're at. But I think that's what you need to see to get encouraged about some of those beaten down names. Folks, that is a wrap for this week. Thanks so much for joining us on our show. All of our previous episodes and interviews are for free at StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great weekend. We'll see you next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.